Interest rates are crashing again and it's giving off major 2008 vibes. Remember that time? Banks were failing, markets were tanking and everyone was in full panic mode. So are we in for a repeat? Let's break it down. So here's what's happening right now. After months of central banks checking up interest rates to fight inflation, we are suddenly seeing rates drop like a rock. Right here you can see the steep decline. This isn't just coincidence. It's the market reacting to slowing growth and cracks forming in the economy. It's like a game of Jenga. The central banks kept raising rates, pulling out block after block, and now things are wobbling. So let's connect the dots. Falling rates sound good, right? Cheaper loans, lower mortgage rates. But when rates crash this fast, it's usually a signal that something isn't quite right. For example, just look at these headlines: slowing growth, tighter credit, and uncertainty in the banking sector. It's a lot like the warning signs we saw in 2008. Speaking of 2008, let's take a quick look back. Back then, rates crashed because of the housing bubble and the collapse of major banks. Central banks slashed rates to near zero in an attempt to stop the bleeding, but by the time they acted, it was already too late. Now today's situation is different, but it also has some similarities. Instead of a housing bubble, we are looking at high corporate debt and a shaky global economy. Different triggers, but the same high-stakes game. But first and foremost, the markets are euphoric. Stocks are at all-time highs, real estate prices are soaring, even bonds and crypto are seeing incredible gains. It feels unstoppable, right? But here's the hard truth. This time is not different. History has shown us time and time again that when markets look invincible, a crash is often just around the corner. And falling interest rates, they are not the savior you think they are, they might just be the trigger. So let's talk about what's really fueling these record highs. For over a decade, ultra-low interest rates flooded the market with cheap money. That money flowed into stocks, real estate, and also in assets like cryptocurrency, creating what some call the everything bubble. So now that rates are falling again, many believe this will keep the bubble inflated. But bubbles don't pop when they are small. They pop when everything thinks they can't. That's where we are right now. Valuations are stretched, speculation is rampant, and confidence is sky high. And when reality sets in, the fall will be devastating. People always say this time is different. They said it in 2000 when the internet was going to change the world forever. They said it in 2008 when real estate was supposedly the safest investment. And they are saying it now with tech stocks, crypto and housing hitting all-time highs. But here's the truth. It's never different. The players may change, but the game is the same. Excess speculations, over-leveraged investments and falling rates have always been the ingredients for a crash. And we are cooking with all three right now. So what makes this bubble so dangerous is the sheer size of debt that's built up beneath it. Governments, corporations, consumers are all more leveraged than before. Falling rates may delay the pain for now, but they can't fix the underlying problems. When liquidity dries up and the debt becomes unmanageable, the crash will come, and the higher the market climbs, the harder it will fall. So what can we now do? First of all, don't get caught up in the hype. Just because assets are at all-time highs doesn't mean they will stay there. Diversify your investments, keep some cash on the hand, and pay attention to warning signals like falling rates and rising debt. Because crashes are part of the market cycle. They are not predictable, but they are inevitable. The best thing you can do is stay informed and be ready for when the tide turns. But of course, always remember, guys, this is not financial information. So the conclusion is this time is not different. Markets be at all-time highs, but the same forces that caused past crashes, falling rates, over-leveraged investments and blind optimism are all at play again. The question isn't if the crash will come, it's when. So don't get lulled into a false sense of security. Stay sharp, stay informed, and most importantly, be prepared. If you found this video helpful, hit subscribe and let me know in the comments. So do you think we are heading for a crash? Or can the markets keep climbing? Let's talk about it. Thanks for watching, guys.